When we think about markets like the stock market, or really any kind of market, it's easy to get caught up in the numbers, all those charts and graphs and figures going up and down.
Right. Yeah, it can
Um,
seem very abstract at first glance, like this detached world of data.
exactly. But what we often forget is that behind all of those numbers, behind every single trade, are actual people.
Real human beings making decisions.
Yeah. And those decisions aren't always based on pure cold logic.
Not at all.
Yeah.
Think about it. Our emotions play a huge role in pretty much everything we do, and the markets are no exception.
Right. Fear, greed, hope, all of that gets factored in. And actually, some of the stuff we've been reading about lately describes markets almost as living organisms.
Oh, that's interesting. Like they have their own kind of collective behavior.
Yeah, constantly reacting and evolving.
And that's a great segue to what we're really diving into today in this deep dive. We're going to explore the fascinating connection between how crowds behave in the markets and how our own emotions can either help us or really trip us up.
Exactly. And we're going to give you some actionable strategies to make sense of it all, to become a more informed trader, or even just to satisfy your curiosity about how this whole thing works.
Right, because whether you're actively trading or just fascinated by market dynamics, understanding these principles can be incredibly valuable.
So we're talking about things like market sentiment, that overall feeling of whether people are optimistic or pessimistic.
Exactly, that collective mood can have a real impact on how prices move.
And it's not always random. There are often patterns that emerge based on what's known as mass psychology.
Right. It's like the whole market is driven by the combined emotions of all the individual participants.
And that's where emotional intelligence comes in.
Absolutely, because being aware of those market-wide sentiments is important. It's only half the equation.
Right. The other half is understanding your own emotional responses to the market's ups and downs.
Exactly, because if you let your emotions get the best of you, that's when you start making those impulsive decisions that you later regret.
Yeah, like buying into something out of pure FOMO or selling everything in a panic when the market dips.
Right. Emotional intelligence is all about recognizing those feelings and managing them so you can make rational decisions even when things are feeling crazy.
And then, of course, there's the fact that the market is never really standing still. It's constantly changing.
Always evolving.
So a strategy that might work really well today might not be so effective tomorrow.
That's where adaptability comes in.
Being flexible, being able to adjust your approach as the market landscape shifts around you.
And that's the third key area we're going to explore in this deep dive.
So we've got these three big ideas: crowd behavior, emotional intelligence, and adaptability. And we're going to break them down, pull out the practical insights, and hopefully help you have a few aha moments along the way.
Sounds good to me.
All right, so let's start by really digging into this whole concept of crowd behavior.
Let's do it.
The sources we've been looking at really emphasize this idea that mass psychology is a huge driving force in the markets. It's not just about the numbers.
Right. It's about how people react to those numbers and how those reactions influence other people.
So it's not always about cold, hard calculations. It's often about what everyone else is doing or what everyone thinks is going to happen.
That's the essence of herd mentality,
Oh,
right? We have this innate tendency to follow the crowd.
like we're hardwired to do what everyone else is doing.
Exactly. And in a market setting, that can lead to some pretty interesting outcomes.
So let's unpack this a bit. In a crowd, individuals often look to the dominant sentiment for guidance, right?
Right. Instead of doing their own in-depth analysis, they just kind of observe what the majority seems to be doing. Are people buying or are they selling?
And if everyone seems to be doing the same thing,
They assume that must be the right approach.
right, safety in numbers.
It's a feedback loop.
Sure.
The more people follow a particular action, the more it reinforces that action for others.
And the sources suggest this goes way back. Historically, being excluded from a successful group could have been pretty dangerous.
Yeah, in our evolutionary past, being part of the herd often meant survival.
So we're kind of wired to follow the crowd, even if it's not always in our best interest.
Exactly. Recognizing that primal instinct can be a powerful first step in overcoming it, especially when it comes to making sound trading decisions.
That's fascinating. All right, so this leads to what the material refers to as the dominant decision effect.
Right.
Can you kind of explain that a little bit more and maybe give us some examples of how it plays out in the markets?
Sure. So the dominant decision effect basically describes how the actions of the majority can influence the decisions of individuals, even if those individuals might have initially had different ideas.
So it's almost like a snowball rolling downhill. It starts small, but as it picks up more snow, it gets bigger and bigger and faster and faster.
That's a great analogy.
Yeah.
So let's say there's a stock that suddenly starts getting a lot of positive attention.